Cardlytics news and events and presentations link. You have to register for the Q4 quarter, but hopefully they will let us in. Okay. Why am I not getting access to this thing? Oh. I need to create an account. Okay. Any questions from the stuff we just discussed about the priorities and what we're sort of looking for when it comes to the earnings call? I guess it's a no. Beautiful. Okay, I was trying to search for the JP Morgan contract when we last sort of had this connection issue. I hope you guys can hear me well. Yeah. Oh, beautiful, beautiful. This is opening. JP Morgan. Amendment. Beautiful. Previously amended. Fourth Amendment extends the contract until 2028. Further amends provisions related to that. Okay, and I hope this is attached at the end of the contract because it is very important. I mean, Fourth Amendment. Fourth Amendment schedule. Okay, it is Exhibit 10.5. Extremely important. There's an amendment as of July 7th. Oh, it's mostly redacted. That's a shame. Well, we'll probably have to speak with these guys to get a better sense of what happened here. But they're changing the definition of supplier billing share. So probably towards the offerers, so the advertisers. Okay. No, I have to dig in deeper into this part. Definitely. Okay, guys, earnings call. Yeah. Earnings. Beautiful. register for the event, and
merchants from other verticals. We are pleased with the early progress with our newest bank partners, and we have a robust pipeline of expected FI and non maximizing value for substantial difference in results. As an example, we've been working with a top 5 bank partner merchandising activities around cashback funds across key metrics. A 48% increase in redemptions year over year. We plan to continue these efforts with several bank partners who are interested in working with us to increase engagement and bring more demand. Now turning to the retail side of our CLO network. On our last call, we announced the launch of the Cardlytics Rewards platform, which strategically diversifies our publisher base beyond FIs. We are now collecting data from our pilot, making refinements to the platform and optimizing for the best consumer experience. In parallel, we are progressing many active conversations with leading merchants in the US and UK. We look forward to sharing more partner updates in due time. While we continue our efforts to expand our supply, we are also working through a notable change with our largest FI partner.
Nothing else happened so far.
Who built their program with our offers over the last several years has recently decided to restrict a large amount of content from running on their channels starting July 1st. While we expected some level of this, we did not anticipate brand restrictions at this scale. The implications are that this partner's users will likely receive significantly less content and less value. We've also heard from numerous advertisers that they are equally concerned about the negative impacts to the efficacy of their programs if restricted from running on the trusted and proven Cardlytics platform. This change is posing significant limitations for our business. Despite our attempts to find a better path forward for us and their customers, we are now focused on mitigating the impact of this bank's decision. First, we will continue to invest in efforts to meet consumers where they are, and we expect to increase and diversify our supply. Second, we are improving our relevancy and targeting tools, which we expect will allow us to shift our content to other publishers that are focused on leveraging the Cardlytics platform to deliver value to consumers. Third, our shift to engagement-based pricing is helping advertisers see our platform as a real performance media ad format. Fourth, we are working with our advertisers to blend TVC reporting, incrementality results, and MMM readings for a more comprehensive view of performance, which we believe will continue to position Cardlytics as a trusted and immeasurable growth channel. For clarity, the restrictions imposed by this bank are unique to this partner, as no other FI partner of ours has imposed restrictions of any similar magnitude, nor do we expect them to. In fact, our other bank partners are leaning into our platform to deliver more value to their users and are growing their share on our network. We are committed to ensuring that our business is sustainable and on a path to profitability. Alexis will discuss more about the financial impact these changes will have. We believe that our network capabilities are a real market differentiator that cannot be easily replicated. Competitors have generally not been successful in capturing budgets from advertisers with multi-unit chain or more sophisticated CLO needs. We hear this time and time again, ability to run the type of novel ad formats that they want. Since these restrictions were imposed, we've seen negligible churn with our restricted brands. The vast majority of them have stayed on our platform so far. Now moving on to our second pillar, strengthening and growing advertiser demand. In light of supply limitation, doubling down on demand is of utmost importance. Our UK business continued to show strong growth with the highest billings quarter in history, driven by strength in categories like everyday spend, subscription services, and retail. We signed over 20 new logos, about half of which are top 150 brands in the UK, and we are focused on growing these accounts and securing longer-term commitments. With more pressure on performance, we are helping our advertisers demonstrate results and working closely with them to develop longer-term CLO strategies. In the US, we also saw increased performance expectations from our advertisers. Advertiser churn was mostly concentrated in mid to small size brands, which have been more susceptible to budget reduction. We saw strength in everyday spend and specialty retail consistent with trends from the previous quarter. Travel and restaurant categories experienced softness in the first half of the year, as we've seen across the industry. We are encouraged by signing new top-tier brands in the US as well, including a leading rideshare player, top retailer, and national restaurant chain. These enterprise accounts are where we see the highest potential for growth and scaling in the second half of this year. In the light of the changes with our largest FI partner, we are focused on reinforcing our relationship with our top advertisers and ensuring their content is effectively delivered across our spectrum of publishers. We have reorganized our sales organization under our new Chief Business Officer and are accelerating our go-to-market efforts with intensity. We have been seeing success with our vertical focused go-to-market initiative, and we will enhance and expand on this strategy. We are also leading with proven performance, which remains a true differentiator in the market against our competitors. And while we diversify our supply, we are also adding new demand to our network. We expect to attract new brands and verticals to fuel our growth strategy with CRP. Furthermore, by aligning US and UK under one leader, we are able to work with leading brands and support their marketing spend across these markets contiguously. Our third pillar, maximizing the performance of our network. We are seeing the benefits of our focused efforts to stabilize and optimize our platform over the past few quarters. Our network is performing effectively and efficiently, bringing more confidence to our partners and advertisers. As recently announced, we launched new dashboards within the Cardlytics Insights portal to bring the full power of our network data to our advertisers. The new dashboards are focused on customer insights, which have historically been generated by our analytics team rather than self-serve and in real time. With the Insights portal, our advertisers can access market data and customer intelligence on demand whenever they need them.
Beautiful. One
client noted, we are sharing these insights internally to highlight Cardlytics not just as a media partner, but a partner that provides real value to our business through data. Lastly, we continue to make progress with the migration to engagement-based pricing models, which are now implemented for 79% of our advertisers. In Q2, 96% of our new business ran on engagement-based pricing, reinforcing the fact that this pricing model is aligned with what our advertisers are looking for, as it provides low funnel signals that are valuable to them.
That's very important.
Engagement-based pricing has also helped us compress sales cycles, align with internal brand measurement models, and we believe it will make us more resistant to churn over time. And our final pillar, accelerating our growth in Bridge. Last quarter, we saw strong and steady client interest for our identity resolution capability, including a long-term renewal with a high-end beauty brand. We also signed a new partnership with a popular restaurant chain that is using our advanced analytics and business intelligence for deeper customer insights. For Ripple, we're encouraged by the positive trend that helped us more than double our revenue quarter over quarter. We recently welcomed Hy-Vee Red Media to Ripple as our newest partner, which will further expand our current scale of over 140 million unique shopper profiles. Building on our efforts to scale supply over the past year, We are now continuing to.
They don't really, break it out the different segments for earnings
The
already.
adoption of our Ripple audiences across different platforms. In fact, we're seeing 10% growth week over week.
Still need to read the thank you, obviously. But
we are continuing to work with new and existing platform partners to accelerate this momentum and drive broader adoption and more revenue diversification. On our last call, I shared that we launched a pilot for CPG offers with one of our large retail clients and bank partners. I am pleased to report that initial results from this pilot are encouraging. Not only did we validate the feasibility of connecting our Bridge and Cardlytics data, the pilot demonstrated a positive impact on both shopper behavior and basket size. Among redeemers, we saw a 30% increase in the rate of baskets containing the specific product, as well as a 2% increase in basket size for transactions containing the product, and a 13% increase for all other transactions. Overall, we continue to move forward, taking a deliberate and thoughtful approach to growing our business. There are undoubtedly challenges that we did not anticipate a year ago, but we believe that over the medium term, the strategic shifts we initiated earlier this year will position us for profitable growth. We are operating efficiently and effectively, and we believe these shifts will ensure that we continue to deliver on our promise to our partners, advertisers, consumers, and investors. I'll now turn it over to Alexa to discuss the financials.
Thank you, Amit.
Okay. Overall, not the best update. We'll go point by point later.
Year-over-year comparisons to the second quarter of 2024, unless stated otherwise. In Q2, our total billings were $104 million, a 5.7% decrease. We achieved our billings guidance by continuing to expand billings with many of our top accounts in the grocery and gas category, which grew 41%. We also had success in the retail category, growing our largest retail advertiser by $2.8 million in billings year over year. We continue to see weakness in the travel category, which declined across a few key accounts. On new business, we are encouraged by the high quality of brands and momentum, with 45 total new logos signed in Q2 and a strong potential to scale. Consumer incentives of $40.8 million were flat to prior year, and revenue decreased 9.2% to $63.2 million, driven by a decrease in billing. Our revenue to billings margin was 2.3 points lower than prior year due to pressures on advertiser performance. Looking at our segment revenue results, our U.S. revenue, excluding Bridge, decreased 13% due to lower billings and pricing pressure, as previously discussed. In the UK, we saw 29% revenue growth, driven by higher billings and increased supply. We grew billings with all of our top 5 clients in the quarter and launched a new advertiser whose billings were in the top 5. Bridge revenue decreased 8% due to the loss of a major account in previous quarters. Adjusted contribution was $36.1 million, down 0.6% from the prior year. However, we expanded our margin as a percentage of revenue to 57.1%, an increase of 5 points due to a more favorable partner mix. This margin is the highest we have experienced to date, driven primarily by growth of our newest bank partners. Adjusted EBITDA was positive $2.7 million, an increase of $5 million. Total adjusted operating expenses, excluding stock-based compensation, came in at $33.4 million, a reduction of $5.2 million, primarily due to our previously discussed reduction in staff and a reduction to incentive compensation. In Q2, operating cash flow was positive $1.2 million. Free cash flow was negative $3.4 million, which was $3 million less than the prior year, due to interest on our 2029 convertible notes and severance payments that was partially offset by improved working capital. Free cash flow improved from the prior quarter by $7.4 million. On the balance sheet, we ended Q2 with $46.7 million in cash and cash equivalents. This week, we drew $50 million on our line of credit, leaving us with $10 million of unused available borrowings. We have $106.7 million of liquidity, including the undrawn amount, or $81.7 million after accounting for our minimum cash covenant of $25 million. As previously shared, we plan to use the funds to pay for our upcoming 2025 convertible maturity, as well as to give us extra flexibility as we navigate the upcoming quarters while keeping our cash on hand at a comfortable level. Lastly, in Q2, we paid the final $2 million of our settlement with SRS, fully closing this matter.
Okay.
As a reminder, last quarter we introduced monthly qualified users, or MQUs, to drive consistent reporting across our FI and non-FI publisher partners. In the second quarter, we had 224.5 million MQUs, an increase of 19%, driven by full ramp of our newest FI partners. Excluding these partners, MQUs would have been up 1%. ACPU reflects how efficiently we convert advertiser budgets to the value that the company can retain. In the second quarter, ACPU was 14 cents, down 15% year over year, as the MQU base of our newest large FI partner has not yet been fully monetized. ACPU expanded 10% in the second quarter versus the prior quarter. Now turning to our outlook for Q3. Our expectations reflect the change with our largest FI partner, which Amit explained earlier. For Q3, we expect billings between $87 and $95 million, revenue between $52.2 and $58.2 million, adjusted contribution between $30.3 and $34.3 million, and adjusted EBITDA between negative $2.3 and positive $2.7 million. Our billings guidance represents a negative 15% to negative 22% decrease year over year. Despite this top-line weakness, we still expect adjusted EBITDA to be break-even, and we further expect to have the highest contribution as a percentage of billings and revenue to date. The primary driver of our expected billings decrease is a result of the content restrictions and reduced supply available to specific brands. As Amit mentioned, our largest FI partner is restricting certain content from running on its channels starting on July 1st. While this option has always existed per the terms of our agreement, this is the largest restriction we have experienced. We are discussing this change with our advertising partners and working to shift as much of this volume as possible to other channels. We are still learning how to optimize projections and targeting based on these changes. While we are undertaking a range of actions to help mitigate this, as Amit discussed, we expect to see some impact to our results, which you will see reflected in our guide. We are still in the early days of this optimization and are modeling conservatively. This change underscores the importance of our diversify our demand. While we navigate the impacts of the expected reduction in billings, we are prudently slowing the pace of some of our investments and focus on overall expense management. We continue to make progress with our newest large financial institution partner. We had twice as many unique advertisers live with this partner in Q2 than in Q1. We expect this momentum to continue and are pleased to see engagement rates similar to our most established partners, and in some cases, higher AOVs and redemption values for certain premium types of advertisers that do well with this unique demographic. We continue to believe there is significant upside as engagement deepens. We are encouraged by our recent run rate in billings, which is now similar to one of our top 5 U.S. banks, and we believe there continues to be upside as this partner scales. Our newest digital banking partner also helps to expand our reach with a different demographic and supports long-term diversification. Consistent with our last call, we are not assuming any material financial impact in 2025 from either Cardlytics Rewards platform or CPG offers. Lastly, the UK continues to be a bright spot as we expect continued strong positive growth in Q3, driven by a healthy pipeline of quality advertisers and continued supply growth. Revenue as a percentage of billings is expected to be in the low 60% range for Q3 as well as for the full year. We have made strategic decisions to drive incremental performance and billings. We expect adjusted contribution as a percentage of revenue to be in the mid to high 50% range. This continues to be among the highest we have seen and reflects our improved economics with our new and ramping bank partners. Despite top-line weakness, we are keeping more of every dollar we make, and we remain focused on driving profitability. We continue to expect this metric to improve sequentially as we diversify our supply. Our adjusted EBITDA guidance is a reflection of our reset operational cost base following the reduction in staff that we completed in May. We continue to hire in our lower-cost technology hub so we can continue to invest in key product areas. Operating expenses are Given the changes for top line, we remain committed to driving operational efficiency, and we will make further changes as needed. As we stated last quarter, we believe we have sufficient liquidity to satisfy all of our financial obligations, including the repayment of our outstanding convertible note. Given our expected top-line results, we are further narrowing our focus and slowing investments until we can show sustained improvement. I'll now turn it back to Amit for closing remarks.
Thank you, Alexis. We remain confident in our ability to navigate the headwinds and focus on our strategy to grow and diversify our platform. We've made meaningful progress on our turnaround over the past year, and we are committed to delivering continued success despite the challenging near-term dynamics. Before moving on to Q&A, I want to thank our teams for their effort and commitment, our partners and advertisers for the opportunity to serve them, and our investors for their patience. I'll now turn it over to the operator to begin Q&A.
Thank you. Ladies and gentlemen, we will now begin the question and answer session. Should you have a question, please press star 1 on your touch-tone phone. You will hear a prompt that your hand has been raised. Should you wish to decline from the polling process?
Well, guys, not the best earnings call, to say the least. I will touch on the first thing I said, long-term versus short-term. My conclusion after listening to this is that this should probably be like a 1% position, because it's either a 0 or a 100x. But in the near term, there's really no catalysts that will push the value of Cardlytics upwards.
Help me understand a little bit better on the
Thank you, Jacob. Thank you for the question. So this is goes broader than the restriction is broader than the brands that the FI partner is currently engaged with or the content you see. We were obviously not expecting this level of content restriction. It is beyond that what our expectation was, and that's why it's reflected in the guide. But we are actively working with our bank partners and advertisers to make sure we minimize the.
I haven't sold it. It is part of the fund. It's about 5% of the fund.
Maybe you could just kind of talk a little bit more on the credit line.
Probably less after this call.
Already occurred, or is that going to be prior to Q3 end, or will that be in Q4?
Thanks. No, so we drew the line of credit yesterday for $50 million. The intent is to pay that at maturity for the notes that are due in September, so certainly not waiting until Q4. That's consistent with the past. Right, we've always intended to draw the line to repay our notes, and also maintain an operating cash balance between 40 and 50 million. So
that's actually fantastic, because the notes that they have outstanding are convertible debt, which means if they're going to spend 50 millions or the line of credit to buy up some of those, that means less dilution, significantly less dilution, actually, for shareholders.
Versus your FI partner is restricting content. How much of the billings decrease sequentially is kind of from each bucket there? I think in the past you had said, billings should grow sequentially throughout the remainder of the year, but the shortfall there, what's kind of in each bucket?
Yeah, I'll take that. So we did not anticipate this when I made the comment about sequential billings growth. I would say a large portion of this decrease is due to the supply change that we're seeing. This partner represents a large portion of our network in terms of billings. That's actually disproportionate to the number of MQUs that it has. So we do believe we can shift some of this volume to other partners. We're only a few weeks into the change, and so still learning how much we actually can shift. So I do think there's room to do better than what I've guided, but being conservative and still learning on how we expect the volume to shift. So I would say majority is related to the partner. We learn, we're still learning this over the next couple of weeks. Emmett, do you want to add anything?
Yeah, no, I think that's exactly right. This is an unexpected change, but at the same time, I think what Alexa that I'll underscore in our bank partners' initial response and our advertising partners' initial response has been very much a lead in response, and so that's what we're engaging with them on.
I appreciate all the color.
Never mind. They're borrowing the 50 million to pay the outstanding that they have. They had for September 2025. So they're not buying up the convertible notes.
Thank you. This is
My bad on that.
Last quarter, you announced.
Yeah, of course, they don't have any cash flows.
To diversify non-bank partners. Just wondering how that initial digital sports partnership has been going, and how the build out of the platform is going, or if there's any other updates on new partners. Thank you, Luke. So we completed the pilot that we mentioned in the previous quarter, and are now collecting data and the initial market feedback so we can optimize customer experience. Even though it was a pilot, but we saw a very positive and promising rates of customer linking their cards and redeeming offers. So based on the initial results, we believe that there is a large potential for us to grow this part of the platform. And obviously now we're focused on iterating and scaling this area. We're also very encouraged by the interest we're seeing with a long pipeline of prospective partners both across US and UK that we're engaged with. So active conversations with the pipelines of several leading brands across verticals, including telecom, rideshare, and fintech. And as soon as we have updates that we can share, we'll bring it back to you. But we're pretty positively. It's very positive, promising that the initial pilot has gone well. Thank you. That's great color. And then also, Cardlytics leveraging AI throughout the platform, and what areas of the business do you think can benefit?
That's a very good question.
Yeah, it's a great question. And it's something that we've been thinking and starting to bring on board recently. So, the three areas that we've been debating and starting down the path. First of all, is within our dev team, our engineering team.
Okay, so I'll use this. Actually, the gist of it is that these guys, for some reason, got punished by Chase. Chase is probably enacting some sort of program that's connected to the Chase Media Solutions, their own offer system, their own offer program, and these guys are competing when it comes to some clients, which is true. Some of the clients that jump, between Cardlytics and Chase Media Solutions, and they're probably going to restrict those people to just, if they've used Chase in the past or something, they have to use Chase again. That's what I would imagine, at least. But I have no idea how this is going to affect Cardlytics. Obviously not positively. That is a very negative thing given, Chase represents essentially like generate. So yeah.
This is Cal for Jason. So maybe first, we've been noticing an increase of local offers on some of your partner platforms. So I was wondering if you can speak to any added traction that you've seen with scaling local offers. Yeah, thank you, Cal. I think we mentioned this in our last earnings call. As we've continued to invest in creating a high-performance network, one of the areas that we've invested and honed our capabilities is very much focused on geo-targeted offers.
Yeah.
So we can now get
local offers are very, very important.
Individual live and where do they shop?
Because they allow you to essentially sell people on small businesses that are next to you. But once again, you need the self-service platform in order for that to work.
Change in QSRs, they're excited about it. Multi-unit, multi-line retail stores are excited about it. So we are definitely seeing benefits in everyday spend, in QSRs, in general restaurant categories, and we plan to continue to bring these local offers where it makes sense across our network.
Great, thank you. And then second, good to hear all the traction that you're seeing with Ripple. Just on the Hy-Vee partnership drivers for the win.
Well, Hy-Vee is just the most recent retailer that they've signed with. It's like 240 grocery stores. Anyway, I'm back to looking at this thing from an eagle eye view. So Cardlytics owned, they just briefly touched on it. To be honest, I don't really have any additional comments other than what I said in previous at the beginning of this thing, or technically the previous audio. On the Portal Insight, Amit did say something about real-time connection. I'm not sure whether they have access to real-time data or whether they have instant access to the data. Regardless, really good update, because this once again was restricted to companies that were creating. They were leading to billings of 3 million or more for Cardlytics on an annual basis. So instead of having that requirement, now every advertiser that uses this can look at the insights, and it's not just percentage of wallet share. It's everything regarding your industry, your product. As for the Chase contract, I'm going to.
Great, thank you very much. Anything you can tell us about the MTU impact? I know you said that it sounds like the billings impact is bigger than the MTU impact, but just anything more you can.
All the sales side analysts just want to know how much money Chase is going to take off the team.
What's the nature of the basis for the restriction?
What is the nature of the basis of the restriction?
Restriction website. And then the comment about the sharing below.
Yeah, they don't want to comment on this, which feels very disingenuous, by the way. If you're management, you should touch upon the details of this contract, because it makes or breaks the thesis, at least for the short term. Anyway, going back to the Chase contract, there's been restrictions imposed on that. We don't really know what they are right now, but I'll have to take a look and talk to a bunch of people in order to figure what exactly they've restricted. As to the Amex contract and implementation, zero update on that. They did mention, the last FI partner, blah, 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 but I'm not sure whether that was Amex. And it was a little comment on that. As for Ripple, increased in active users, they do have, I think it was 224 million monthly qualified users, which is, they redefined the concept of monthly active users into this new thing. Let me search for the exact definition. Monthly qualified. Okay, so what constitutes one of these? Targetable customers that have made a transaction using their account with an FI partner or non-FI partner in a given month, excluding pilot supply during the ramp-up period, and whose transactions that data was shared with Cardlytics. We then calculate the monthly average for the periods presented, and we believe the MQU, monthly qualified users, are essentially an indicator of Cardlytics platform's ability to drive engagement and reflect on consumer bases and insights. That is true. They get really good data from this. So they jumped from 188 million monthly qualified users to 224 million, which is very good. But once again, if billings doesn't decrease with that, well, then there's a problem, because it means that for every single user they have, they're just making less money. They also redefined the concept of ARPU, average revenue per user. Now it's called adjusted contribution per user, which I guess is okay, because technically ARPU did measure the metric on revenue rather than the amount of money that they make, which is the adjusted contribution. The difference between revenue and adjusted contribution is fairly simple. It's just the amount of money that you're paying to the bank partners. So, starting from the adjusted contribution does make sense when it comes to understanding revenue figures for a user, or unit economics. Technically, it's user economics. Anyway, that is the update on that. They also mentioned 96% of advertisers using engagement-based pricing. Guess this is okay. It doesn't really change the amount of money that they're going to make. It's essentially a pay-as-you-go sort of product. Back in the day, they used to have 40-day campaigns. Nice. So that's the end of the earnings call. They used to have 40-day campaigns. 40-day campaigns means essentially 40 days where you don't really have a proper result as a bank. You don't really get the data. You get the data with a lag of 40 days. And that does affect everyone involved because everyone is getting on that lag. And if you don't have a pay-as-you-go schedule, or pay in this case as you're engaged, what happens is that the cash flow for Cardlytics gets delayed substantially. Because banks and advertisers, they want to pay for results. Banks want their money in as soon as possible, and advertisers want to pay as late as possible, especially when they haven't seen the results. So, given this is, it makes them more resilient, quote unquote, to churn, which is true because you're getting paid as you are spending these out. Ripple. Oh, and they did the SRS payment, which, as expected, they paid down the money that they had, or the money that they owed. The only thing that I haven't touched upon is the use of the credit line. They have a 60 million credit line, and they are using 50 million of that to pay down the debt that was due on September 2025. So, don't know if you remember this, but back in, I think it was February 24. Yes, I think it's February 24. But if it's not February, it's March. They put out some convertible debt that's paying at 4.25. The convertible debt essentially raised money to pay for the already existing debt that was paying 1%, and the existing debt was due on September 2025. Since it's August and they have to pay this down, they're using the credit line to pay for that. They have 46 million outstanding. You're going to use 50 to pay that. Initially, I thought they would use it to repurchase the convertible debt, which would be amazing because dilution and all that good stuff. But that doesn't seem to be the case. The conclusion I get from this entire experiment, I'm going to call it an experiment because it's not really, it's fairly distant to the way I invest right now. It's part of my evolution, I guess, but it's not really how I do things now. I would make this like a 1% position. I don't think it's worth to have a 5% position, which is my current position, just because it's a 0 or a 100 type play where if they fix these problems and they start going towards the self-service, they start serving the smaller clients, and they can do that on their own platform, or they can, connect the data from Bridge and make that available for advertisers. Then, they should have 10 times, 20 times, 50 times the revenue that they have. But if they don't do that, dilution is just going to keep eating at the money that we as investors put in. And it seems to be the case. Like Amit just got another bunch of shares, 2 additional members shares. So Amit, an additional 1.2, these guys 400,000. It just keeps stacking up. And if you look at stuff like the free cash flow numbers, they look okay, but it's only because you have 2 very, very, very important lines that they're discarding. One is asset write-downs, and the other one is stock-based compensation. In terms of asset write-downs, well, they wrote down the assets I'm guessing Dosh is also going to be written down, but mostly the assets of Bridge at the time. And in terms of stock-based comp, well, they're paying themselves. I think it's about 30 to 40 million bucks per year, which makes it what, like 50%. Let's call it 40% of Cardlytics market cap right now. I don't know where it's at, but I'm guessing probably substantially lower than it was at the closing of the day. Anyway, if they're paying that and they're counting asset write down as part of the non-cash, outflows, sure, you're gonna get a positive, break even, in this case, free cash flow number, which is what they got. Once again, I haven't really done the numbers because the thank you just was released, but that's sort of what seems to be the case. So yeah, that is sort of my wrap up. If you guys have any questions, feel free to, post them. Feel free to message me. I'll give you, 2-3 minutes to post stuff. But yeah, that's sort of the wrap up of this quarterly call. $25. Okay. Say I said 30 to 40 million. Well, to be honest, they're not burning cash right now. They're at break even in terms of cash. What they are is they're burning us as investors because they're diluting us by about $8 million, $8 to $9 million per quarter. So yeah, I said 30 to 40. Technically, it should be 32. Then these numbers, 32, 33. I don't know where the latest quarter is, but yeah. They are not burning cash though. In terms of like hard cash. They're about that break even. Any more questions, guys? If not, I am going to wrap this up. I'll restate. Chase Media Solutions. They have an internal program, and they've been essentially stealing customers from each other. Back and forth. Sometimes the profitability from the net. Yeah, essentially the profitability for an advertiser is greater in one of them, and not so much in the other one. The reason is essentially Chase subsidizing offers. So Chase has been putting out offers that are like 50%, cashback, and those are not provided by the advertiser, but rather, out of that 50%, 10% will be provided by the advertiser. The rest is subsidized by Chase. And so, if that's the case, the advertiser will choose Chase. If that's not the case, if it's not subsidized by them, they will probably choose Cardlytics just because it's way more efficient. Leave that. But yeah, they've been jumping, back and forth. Any more questions, guys? I can't really say anything about the medium to long term. They did not comment on the Amex contract, for example, which was one of the things that I, had as a pressing issue. How's that developing? How are they deploying, the the, the system? Are they integrating the offers? Are they trying out, XYZ? Is 20% of their user base already integrated? That's sort of the update I was looking for. I had no information on that, unfortunately. But yeah, so I honestly have no idea when it comes to medium to long term. I can tell you that short term, not very promising. What do I plan to do with my position? I don't know. I still need to have some more conversations because I need to understand the restrictions imposed by Chase. That's extremely important, obviously. Um, and I need to, well, get more details on the portal, to be honest. That would be the two things I need more information on before acting. Yeah, but you guys saw it on the July update. I think on my personal portfolio, well, it's the only position I have right now. I thought earnings would play out differently, but it doesn't really matter. The reason I was holding it as the only position was because the price versus value doesn't really make any sense. Like, I'm not selling at 50% discount. It's like selling at 5% of what it's actually really worth. So I just don't know. It's one of those things that has massive optionality. But I thought that Catalyst would be, closer. Once again, if I had to purchase this today, it would probably be like a 1% position, and it's 0 or 100x, and nothing in between. And you're probably gonna have to hold for like 10 years for either to actually materialize. I hope that works as an answer. Yeah. Any more questions, guys? I should get a proper setup. I know. I have spoken with Cliff multiple times in the past. Not in the recent, let's say, probably not in the last 12 months. I do have some of the numbers on CMS profitability. I can tell you they're losing heaps of money. They're losing a lot of money on Chase Media Solutions, but it's JP Morgan, so they don't really care because in proportion to the other stuff, just in proportion to the Chase side of things, which is the commercial banking side of things, it's just peanuts for them. With that in mind, they have the infinite money hack and they have time on their side because unlike Cardlytics, Cardlytics needs to make money in order to survive. That subsection of Chase does not. I mean, they've also done this in the past. Right? In 2016, JP Morgan did a very, very similar thing. They lost heaps of money and then new management came in and they closed the entire thing. In this case, they bought Chase Media Solutions. They bought, I think, I can't remember its name, but they bought this thing from Kygo. And, I guess they'll try to make it work. I'm not sure whether profitability is up there in terms of priorities for them. I honestly don't think it is, actually. But who knows? Maybe new management comes in and they close the entire program. Don't think that's likely, by the way. Yeah. Any more question, guys? Keep saying questions. See you in Sweden. Yeah, I don't know when that's happening. When, who knows? Maybe I'll actually live in Sweden at some point. Lots of interesting companies over there. That's for sure. Yeah, as you guys asked a bunch of questions, I'll just run until the end of the hour, just in case. But yeah. Well, I did track them. I use software to understand logins, both on the end of who logs into the platform and whose platforms these are linked to. And both City and Capital One did appear multiple times. I don't have any leads on them joining. I just know that they tested Cardlytics, and I got confirmation on that as well. If one of these banks joins, it's amazing and whatnot. But once again, it's gonna take a long time because the implementation of it is very bank dependent, and banks move very, very slow. You can see that in like everyone but JP Morgan. JP Morgan is probably the exception because they bet really, 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 really hard on small and medium businesses. And so I know that they wanted to launch, well, essentially the equivalent of Bridge, whereby you could analyze the POS data and modify a bunch of things. Like they wanted to launch a service that allowed them to tell small and medium businesses whether they should close and open, more hours, whether they should hire more people, how their demands fluctuated, and how they could, benefit from selling more of product X versus product Y. That was their end goal with the entire acquisition of what is now known as Chase Media Solutions. With that in mind, they need to develop a lot of software in order to get there. I'll do 3 more minutes. Okay. So there's going to be a posting of this in case you want to see it. I won't advertise it, but see you around. In case you want to recheck it, I would encourage you guys to re-watch or at least re-listen to the earnings call, because there's always some details in there that you can get better data on, and by rewatching the entire thing while reading the 10Q, you're gonna have a lot more context. The catalysts are pretty much the same. Any updates on the dashboard, the insights dashboard, and the Amex stuff. In this case, we have negative catalysts, which are the restrictions of JP Morgan, and those we need to understand. Yeah. Anyway, I'm gonna close this out. Thank you very much, guys.